my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The recent moves higher throughout January have been dictated by two bullish patterns, and possibly a third nascent one. The mid-September 2021 uptrend, currently at 235 even, has run this market higher in cooperation with the parallel rising short-medium moving average, currently at 236.20. More recently, we have the November 2021 to start of January 2022 bullish shift pitchfork, of which the lower time, currently 232.5, also runs parallel to the short-medium moving average and the uptrend. Then we have a possible new pattern, still in formation. The early November 2021 to date ascending and inverted scallop pattern. The main scallop was constructed during November and December. In early and mid-January had the valley created after the end of construction of the scallop. However, whereas prices should normally either rise solidly up through the previous high of the pattern back at the start of December, or alternatively head down to the base of the scallop, and that's the 50% Fibonacci line of the July to December 2021 move at 200.05, well, we've seen neither. Instead, we seem to have started a move higher, but it has been well contained topside by the middle time, currently at 253.20, of the previously mentioned bullish shift pitchfork. Yet at the same time, the three parallel supports of uptrend, lower time and short medium moving average have all held up and indeed helped push prices higher. Thus, this pattern is in need of a move, and soon. Only then could I realistically give an idea of any possible targets topside. London coffee. Okay, so the market has recently been held up by the slowly rising short medium moving average, currently at 22.23. However, 3 weeks ago, this was tested, and last week, the short medium moving average gave way under the onslaught of a weekly key reversal down. Last week, we had the inkling of a follow-on move lower last Monday, but this was not sustained as the day ended up as an indecisive doji cross. I suspect this indecision was due because we have a congestion band between roughly 20.95 and 21.75 dating from September and October last year. Now, to be honest, this is a reasonable congestion band, but the overhang of supply overhead is quite considerably more, and I suspect that this support may well be tested once again. Last week, we saw the rise of the market up to the slowly, well, still gently rising short-medium moving average. But last Friday itself saw a clear bearish pattern, a bearish dark cloud cover pattern. Thus, it is not the greatest surprise that though today we have opened higher, prices have still headed lower and currently look like a possible bearish double pattern. Now, going back a bit, I said last week that, and I quote, "I suspect that a support band exists below, dating from the middle of 2021 as well as 2017. It also has a number of Fibonacci levels in there as well. This band is between 1945 and 2005. The only other support of note is a two-pointer underwhelming April 2021 to date uptrend, and that's currently at 21.28, which is not that impressive." That's the end of the quote. This is still the case, though the congestion 2095 to 2175 from last year, plus the June 2017 high at 2177 and the August 2017 high at 2173, have done some pretty good work in halting the decline. It'll be interesting to see if prices do once more head lower. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.